Investing in international equities requires an understanding of the economic growth and currency movements for each country in which you're invested. Today, the direction of currencies and economies is largely dictated by central banks. We will illustrate this using Europe as an example. The European Union is still struggling to recover from a recession that ended in 2013. Early in 2015, Mario Draghi, president of the European Central Bank, or ECB, announced that he would attempt to heal the region's economy with a treatment that proved highly effective in the US, quantitative easing, or QE for short. QE is when a central bank purchases government securities to lower interest rates and increase the money supply. So far, the European Union, or the patient, is responding well to this treatment. We can see how the ECB balance sheet grew as it began buying assets last March. The private banks could then lend their proceeds from these sales to consumers, and we indeed saw a sharp uptick in household credit right after QE began. As consumers spent this money, the economy should continue to pick up steam, as we've seen gross domestic product growth accelerating after March 2015. That's good news, but let's not forget the currency component. In 2014 and 2015, the Eurostoxx, a broad index of Eurozone companies, was positive. But the return for US investors in US dollars was negative. The difference was due to the currency impact. Central banks play the dominant role in driving currency movements, as cutting rates and buying bonds negatively impacts a country's currency. The combination of the Federal Reserve ending its QE stimulus, while the ECB was ramping up its own QE, pushed the US dollar up by roughly 27% over this period relative to the euro, and this decimated domestic returns for European stocks. What does this mean for US investors investing in international equities today? So far in 2016, we've seen the Federal Reserve slow down its plan for interest rate hikes, and the US dollar has subsequently fallen, which may forestall the adverse currency impact that dominated international stock returns over the last 2 years. Meanwhile, global central bankers' efforts to revive their economies appear to be working. Thus, international equities may post positive US dollar returns this year. However, we are paying close attention to make sure that unconventional policy tools like negative interest rates or corporate bond purchases do not cause the patient any adverse side effects.